It's that time of year again. Tax planning. What you do now will determine how much you pay next April. Now, what if you could make an investment in ATM machines today, get high double-digit cash-on-cash returns, and write off the entire investment this year? Guess what? If you are a business owner, you can do exactly that. Interested? Well, I know I am. Email my friend Dave Zook at atm@therealassetinvestor.com to find out more. Again, that's atm@therealassetinvestor.com.
You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast. Today, I want to start out again by reminding you that you can get a free copy of my book, 7 Secrets of Eternal Wealth, at wealthformula.com, or you can simply text me 44222 and type Wealth Formula, one word. Go ahead and do that. It's easy, or you can go to Amazon and buy the book, but it's a good place to start. I think some of the information in there, if you listen to this show often, is going to be basic because you're hearing me just pound away at the same stuff. But for those of you who are just starting to listen, this is a good place to start. You can also go to wealthformula.com and pick up a copy of George Newberry's book, Burn Zones, a book everybody who's interested in becoming a big-time real estate investor ought to read. He'll send you a copy to your door if you give him your address. You can also get various downloads, lots of education there. Just check it out. Go to wealthformula.com and download some stuff, will you? So the other thing I want to, before I get started, is just a nod to American Homeowner Preservation. This is George Newberry's company. George has got a company that I love, which what they do is buy notes, mortgages, failing mortgages from banks at pennies on the dollar, turn around, use investor money to buy those up from the banks, and then instead of kicking people out of their homes, they keep them in their homes for a big discount, rent-to-own situations. Investors end up with a 12% preferred return. I have been an investor myself for years. Love it. Check it out. ahpfunding.com. That's ahpfunding.com, American Homeowner Preservation. Now, rules are made to be broken. That's sort of the theme of today's show, because when you listen to my podcast or read my book or really, my widgets, a lot of my widgets, you might think, hey, this guy's, pretty rigid about investing. After all, he's got principles. He's got principles of wealth creation. Invest in cash flowing assets. Understand how your investments work. You got to be able to write them on the back of an envelope, or don't invest. Invest in real things that you can see, touch, and feel. Invest in things that people need. Food, water, places to live. Use the mathematical principles of wealth creation, namely velocity and leverage. Well, listen, a lot of these are incredibly important, but does that mean that every time I invest in something, I do like a checklist and make sure, like a pilot in a plane, that each one of these criteria is met? Well, no, clearly not. As you may know, I'm a huge fan of the life settlement asset class. Now, if you know a thing or two about life settlements, there's no monthly cash flow there, and I don't know if an insurance policy counts as something real or not, but I do know that people who are over 80 years old and have multiple health problems die, and that buying their life insurance policies at a huge discount is a pretty good bet. So in that scenario, the cards are clearly stacked in my favor as an investor, right? So when else might I consider breaking these rules, these secrets of eternal wealth? Well, I will say that over the years, as my own wealth has grown, I have realized that one of the biggest principles wealthy people use to grow their own wealth is insider information. Now, let's be clear. I'm not talking about illegal Martha Stewart kind of stuff, right? The stuff that you're not supposed to do, and you see these people from Wall Street going to jail. That's not what I'm talking about. I'm talking about knowing people who are some of the top authorities in a given asset class, the people that make the markets, or the people who are truly elite operators. Now, wealthy people follow these people and find out about things ahead of time because they know them. They get their money in early in these opportunities. And by the time the general public hears about the opportunity, there's little meat left on the bone, if any. They're fighting for the scraps. And on top of that, you might even qualify because you're not an accredited investor and the deal's only for accredited investors. So meanwhile, the insiders enjoy massive gains and might even exit their positions while the outsiders continue to buy up scraps. Now, here's the problem you have, or that you may have, as a high-paid professional. Tell me if this sounds like you. You make a lot of money, but not enough. Or maybe you make enough, but you don't live in that world. You know, you don't live in that world, the one I'm talking about. The way you invest, frankly, is no different than the way the poor and the middle class do. Does that sound like you? If so, understand that despite what your wealth manager, your wealth, whatever, your wealth guru says, you are still fodder for the market makers. You aren't an insider. You're an outsider. And you're there just to pat everybody else's pocket who's on the A team. So who are these market makers anyway? It's hard to get to know these people and about these opportunities if you're not wealthy. And I bet you're thinking to yourself, hey, I kind of figured this, You suspected something like this already. And I'm here to tell you that you are right. Now, I'm doing my best on Wealth Formula Podcast and through this community and everything I'm doing to help you get in on some of that unfair advantage of the wealthy. And hopefully, you have already learned things that have opened your eyes to a whole new world. I sure hope you have. I got to tell you, I have a lot of stuff, especially in Investor Club for the accredited investors. But hopefully I have created tremendous value, or at least given you some ideas that you hadn't thought about or didn't know existed through this podcast. But there are some things I have to tell you that until you really start creating significant wealth and or start living in the insider's world, you're going to remain an outsider. And listen, that goes for me as well. It's not like I'm Mr. Insider guy on everything. The thing is, there are actually layers to this insider thing, right? So you can kind of be a little bit more of an insider than somebody else. And so, it's kind of like peeling away at an onion. And, I'm further in. I'm like more of an insider than most, but I've still got layers to peel away ahead of me. And here's the thing. Here's one of the things I've realized is that the deeper you get into the layers of this inside world, the advantages become even more pronounced. And that's just another reason why the wealthy continue to get wealthier over time. None of this sounds fair, right? Well, it's not. But life isn't fair. I'm sorry if it isn't. And if you're a burner, I'm sorry, this just doesn't work for you. And this is the way the world works, and this is how it thrives. What you need to do, in my humble opinion, is to focus on finding your own unfair advantages. You can also protect yourself. Listen, if I don't know anybody, I'm not an insider, but you can protect yourself by doing what? By sticking to the principles that I always talk about. Because if you stick to cash flow, real asset investing, velocity, and leverage, if you stick to these things, you can still build wealth the old-fashioned way. You earn it, right? So anyway, today, my guest on Wealth Formula Podcast is an interesting guy. He understands this whole concept of the insider's world well because this is very pronounced in the industry that he is in, is sort of the precious metals, junior mining sector, highly volatile, but in significant insiders world for sure. In fact, he understands this whole idea of insiders world well enough and believes in it enough that he has built an entire community of outsiders to try to make sense of what he would call sort of a bizarre world and economy in which we live. And like me, he tries to help people who are outsiders get in on some of the insider action. His name is Nick Hodge. He's the founder of Outsiders Club, and he is my guest on Wealth Formula Podcast today, and you'll hear from him when we come back.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the United States. Our simple, proven system will help you create real wealth and passive monthly cash flow. Learn how to find the best deals by downloading your free copy of The Ultimate Guide to Passive Real Estate Investing at noradarealestate.com. That's Norada realestate.com.
There is no excuse for lazy money or lazy retirement money. After all, it grows tax-free. With Impact Housing, you can invest with a team that has a strong track record of making investors money through value-add strategies of neglected apartment buildings nationwide. The Real Estate Crowdfunding Review just named Impact Housing to their top 14 real estate investing sites for non-accredited investors and gave industry honors to it for most experienced sponsor and most socially conscious. Put your retirement money to work with an investment in Impact Housing. Head over to impacthousing.com. Again, that's impacthousing.com. Welcome back to the show, everyone. Today, my guest is Nick Hodge. Now, Nick is the founder and president of the Outsider Club and investment director of Wall Street's Underground Profits and Early Advantage. Nick's co-authored 2 best-selling books on energy, and one of his books actually includes Energy Investing for Dummies, which is probably good for most of us when it comes to this sector. And he shares his views and strategies all across the country, speaking where I saw him, which was the New Orleans Investment Conference, the Cambridge House series of conferences, and the Money Show. So, Nick, welcome to the show.
Buck, it's a pleasure. Thanks so much for having me.
Well, so I saw you at the New Orleans Investor Conference, and I was thoroughly entertained and educated. So this should be fun. So before we get too much into the economy itself, take us back a little bit. Tell us exactly about, because the big thing I think you're focused on is Outsiders Club. That's your community. What is it? Why did you start it?
Yeah, it's Outsider Club. It's a retail investment site for people who have a little bit of a contrarian worldview or even a libertarian worldview. And the reason I founded it is I started in this newsletter investment publishing space in 2007. And my assigned beat then as an assistant editor was the clean tech space. So I was writing a lot about wind and solar and hydrogen fuel cells, and all that stuff was really fun in 2007 when I was a 23-year-old kid and the solar stocks were going up on high volume, 10% a day. But then 2008 happened and all that got wiped out very quickly. Mm-hmm. And it sort of left me scratching my head as a young kid in the space, wondering, what happened to the market? What happened to all that wealth that was destroyed? Where did it go and why? And so after I searched in my heart of hearts and talked to my mentors and tried to really figure out what was going on in the investment world. And I gravitated, I think as most people do when they have that come to Jesus moment, to real hard assets, primarily things like mineral wealth in the ground, but also, forestry and timber and ag. And so I think it was, like I say, a come to Jesus moment for me. And I founded the Outsider Club on the back of that philosophy as a community for like-minded individuals that want to manage their own investments outside of the influence of the Wall Street machine and the DC Beltway machine. And that's the nutshell version.
Yeah, and I guess there's different ways to do that. I think the philosophy, generally speaking, of this show, of Wealth Formula Podcast, is similar. It's the idea of, looking outside of some of the mainstream things and finding value where there's value to be had, rather than, just kind of doing the same thing and hoping you'll do better, when you haven't done so in the past. So, one of the things you talked a little bit about, I enjoyed it. So I'd like you to kind of talk a little bit about, when you relate to what's going on in the world right now, you do find a lot of things to be a little bit bizarre, right? So so you got to tell us some of those things, what you were talking about.
Yeah, sure. I think the talk that you saw in New Orleans was about where to put your money in Bizarro World, and I sort of gave a bunch of examples of what I've come to view as Bizarro World, and I can run down a couple of those examples.
Sure.
The first, I mean, basically the notion is that a lot of things that you see around you are fake, and I started with the Volkswagen diesel emission scandal and how, that was just completely fake. It was systemic from the top of the management all the way down to the bottom of the company. It wasn't a clerical error. It wasn't a paperwork error. I mean, these guys, this major international multi-billion-dollar company was just outright lying about their emissions data. And what happens when that's revealed to the public is the stock gets cut in half. I mean, your wealth is cut in half almost overnight. Another example I gave is the popular wristwatch type deal, the Fitbit that people wear to keep track of their steps and their heart rate and sleep patterns. And that was a publicly traded equity as well. And it was a very popular IPO. And about a year after the stock started trading, a report comes out that says the data that this Fitbit is generating is fake. It's, it could have your heartbeat off by as much as 80 beats per minute. And so, I mean, that's just fake, right? It's a device that doesn't do the one thing it's supposed to do. And what happens to that stock? I mean, that stock also, it loses 50 to 60% of your money when that news comes out. And I mean, it just goes on. The week before the New Orleans conference, there was a big Japanese steel company called Kobe that was found to be fudging the numbers for the strength and integrity of the metals it was producing, the steel and the aluminum. And this is a serious deal. I mean, that's steel and aluminum that goes into cars that you drive and planes that you fly in. And they're lying about the structural integrity of it. And when that news came out, the stock got obviously obliterated as well. But I think my favorite example, although it's not a publicly traded equity, was this juicing company that Silicon Valley had raised $120 million of venture capital for. And it was this fancy internet-connected juicer that you had to buy these pouches of juice for, and the machine would squeeze the juice out. Well, Bloomberg did an investigative report and found that you didn't even need the juicer to squeeze the packs of juice. You could just buy the packs of juice and squeeze them with your hand. And so it's a completely unnecessary and, of course, fake and bizarre device that has somehow roped in $120 million of capital. And I mean, I see examples like this all the time. Those are some of the most egregious. But to me, that is just bizarre that these are companies that are promoted on CNBC and have large followings, and their devices and their products and their data turns out to be just fake. I mean, it's crazy to me.
Well, what's interesting about that, I think, is that, obviously I'm very much involved with the private placement world, as are you. And, a lot of the listeners of this show, particularly in my investor group, but, a lot of people who are new to private placements, they tend to, they get a little nervous, right? Like somehow with the publicly traded stuff that they think that they're safe, that, that for some reason, that people can't fake things and create data that's not real, et cetera, just because it's a publicly traded equity. I mean, I think that's really what this comes down to, is you're saying, maybe not quite, right? I mean, it's just kind of bizarre how this stuff gets past everyone, no matter where it is.
Yeah, I mean, you would think that either internally at these companies it would be checked, or by the regulators it would be checked, or by some government oversight body it would be checked. And yet that's simply never the case. It seems like, I mean, take it all the way back to like the rigging of LIBOR, for example. Nobody caught that, and that's tens of trillions of loans that are tied to LIBOR. And that was manipulated successfully by Deutsche Bank and others. So, I mean, you wonder how that happens, but then you look at the follow-up and it sort of makes sense, right? I look at it like the Mafia. These companies get caught doing things by the government, and they just have to pay a portion of their ill-gotten gains as fines to the government. And the government is sort of just skimming off the top. It's like, oh, we caught you, but there's never any formal ramifications. It's just, oh, here's the fine you got to pay. Put it in our coffers and let's move on.
They've probably budgeted for those already, so...
it's incredible.
Let's apply some of this sort of bizarre stuff to the economy today. I mean, for a guy who's looking for bizarre things, you're probably seeing a few bizarre things going on in the economy in general.
Well, I think there's a lot of bizarre things. And the biggest one, of course, is this unprecedented monetary experiment that we've undergone for the past half decade or so. I mean, to me, I just look at interest rates. And by definition, an interest rate is, supposed to return you money, some percentage of your money for taking risk or lending capital. And we live in a world where that's been completely turned on its head. We live in a negative interest rate world. And somehow that's been completely swallowed as normal by the bulk of the mainstream investment community. And, it's not hard to see why when it buoys equities to multi-year highs on a daily basis. I see the payoff and why people support that. But at the end of the day, to me, I mean, that's the antithesis of what capitalism is, right? I mean, it's being monkeyed with at the highest of levels that control interest rates. And so to me, all things are out the window when you have a monetary system that has been tampered with like it has been. Yeah, I think it's very bizarre.
So what is that? Where does that leave people who are, thinking that they're investing the same way they invested 30, 40 years ago, right?
Yeah, I think what's going to happen is ultimately there's going to be an explosion of this bond bubble. And I think that's what's going to cause a cascade effect for money that is traditionally invested to say, hey, wait a minute, let's see if we can maybe find a safer haven, a more traditional real asset to put that money in. And that's, in my view, what's going to be a real big catalyst for real investments, hard assets like land and agricultural assets and mineral wealth like precious metals, because those markets are so small and they've been ignored for so long because stocks are going up. Nobody has put their money in these assets, that if just a tiny, tiny amount of the capital that's invested traditionally moves into these spaces, you could see them revalued much higher very quickly. And that's the main catalyst I'm looking for. And that's the catalyst I'm telling my readers to look out for as well, and positioning them ahead of that money moving into the traditional sectors.
So for those people who don't understand that, the idea of what's going on in the bond markets, and that's going to be a lot of people. I mean, we have a lot of high-paid, smart professionals, but really aren't following the markets. Can you try to explain that sort of in a, for dummies way approach of what's wrong, what's going on with the bond market, and why you think that's going to implode?
Yeah, well, let's just take Japan, for example. I'm not going to try to make up the numbers. I don't know them off the top of my head. But in Japan, you have the Bank of Japan owning, it's something like over 50% of the bonds and over 50% of the equities. So you have a central bank that's owning all these assets, and they can't fund themselves indefinitely to do that forever. So at some point, they're not going to be able to buy the equities, and they're not going to be able to buy the bonds, and there's going to be an implosion effect. I mean, that's the simplest way I can explain it. It's unsustainable for central banks to have this amount of assets, both bonds and equities, on their balance sheet. And the Fed is starting to unwind now, albeit very slowly. But I think the situation in Japan and Europe is much more unstable. Those countries aren't the reserve currencies of the world like the U.S. is. They aren't the largest stock market like the U.S. is. And so I think they'll have problems sooner than the U.S. will. And so I think when you see Japan and Europe start to have problems with their central banks and bonds, I think that's the spark to let you know that this thing is starting to end badly.
And what does that look like? What happens to bond prices, et cetera, then?
Well, I think you see equity prices start to fall off a cliff, and the same with bonds. I think the yield curve is going to invert, where you see short-term bonds having higher yields than long-term bonds, and that's the inversion of the yield curve. And I think that's what it begins to look like.
Yeah, that's kind of what I was getting at, but I just want to make sure people understand the idea being that basically the idea, is all that money in the bonds basically looking for a better place
a new home.
Yeah, a new home. Right? I mean, that's effectively
exactly.
It. So, you're, this New Orleans Investor Conference, which was really cool. One of the things I like about it is when I go there, I feel like I'm a very young man, right? I mean, I'm 44, but I've got to be probably 20 years younger than the average participant in that audience. Now, and you're a really young guy. Right. So why? I mean, obviously you have exposure from your time doing green energy, et cetera. But what's so exciting to you about this sector right now?
Well, I think if you're talking about precious metals,
yeah.
Yeah, I think the cyclicality of it, when I first got into this investment world in 2007, it was just at the tail end of the uranium boom then that was caused by the flooding of a big mine or mine to be called Cigar Lake, and uranium prices went from something like $40 to well over $100. And then after that, I saw, but I wasn't yet involved in the space, I saw the gold price, go to its record much higher than it was now in 2011 or whatever that was. And so I've seen the cyclicality of the markets, and I understand the cyclicality, and I think we're due for that cycle to turn. Now, what do I mean by that? Well, I mean that since 2011, gold equities across the board have lost some 85% of their value. Mm-hmm. And I mean that since Fukushima happened, uranium equities across the board have lost more than that, some 90% of their value. And so there's been no efficient use of capital. Nobody has gone out and looked for and found new gold and silver reserves that majors can acquire to replenish their reserves. And nobody's gone out there and find new sources of uranium that can supply us, for the next leg of the utility cycle. And so, by the definition of supply and demand, I think low prices beget higher prices. It's a line that Rick Rule uses all the time. The cure for low prices is low prices. Right. And that means the price of the commodity has to rise to incent new discoveries and to incentivize new production to come online. And so I think in a very real way, we're at the bottom of those cycles where the prices of, uranium and gold and silver and things like copper have to go up to make marginal new projects economic to mine so they can be brought online. And I think that's the catalyst for, much higher metals prices and by extension for much higher equity prices in the junior companies, which is the space I dabble in, the small mining companies that provide you leverage to that rising commodity price.
Right. So, I've heard a lot of people in the commodity space really kind of talk about this time that we're in is the beginning of a substantial bull market. I mean, obviously, things go up and down even the course of 7-8 years, but there's something bigger happening right now. Do you agree with that?
I think there's something bigger happening because it's twofold this time. On the monetary side, you have the unprecedented monetary intervention from central banks that, traditional gold bugs would point to as a reason for gold to be higher than it is now. Sure. But what I like is the very real thing happening in the precious metal space, the notion of peak gold. And what I mean by that is it used to be major gold companies like Barrick and Newmont. They used to have 30 years of gold and silver reserves in their coffers and in their proven and probable reserves. And they've let that slip down because the precious metals prices have been so low for so long. They haven't had the impetus or the reason to refill their reserves. And so they've let that number slip to somewhere down to 15 to 20 years of reserves left. And so what has to happen is these big gold mining companies, they have to go out there and they don't explore because they're too big to do so. They have, their staffs are too bloated and they're too bureaucratic to go out there and have a real effective discovery program. And so what they do is they go out and buy up junior companies that own assets that have been discovered and de-risked by, either installing infrastructure or doing a preliminary economic assessment or a bankable feasibility study. These major miners, they'll go out and they're going to acquire these smaller companies, I think, at a much faster clip. We've only seen it, start really with a couple of small acquisitions in the past year or two. But I think the floodgates are going to open, and that's what's going to drive this two-pronged bull market. The majors needing to replenish reserves and the monetary stuff.
Yeah, that makes sense. A lot of people stay away from this stuff. The metals and the junior miners and that sort of thing because of, obviously there's substantial volatility, right? You're talking about markets dropping 80, 85% at a time. How do you play in this market and avoid getting killed?
Well, there's two ways. If you're talking about the big companies, you can invest in companies that are less volatile, and then you just invest in companies that have much larger market caps in the billions of dollars, as opposed to the junior companies who have market caps in the sub 100 and much smaller sometimes. So that's one way is you diversify across the sector in some bigger companies that can help make it not so lumpy. But the other way, when you're dealing specifically with those risky small junior mining stocks, SPACs is to do extreme due diligence and have a network in the sector of people that have seen it before and done it before. And so that has been my saving grace, I think, over the past couple of years, and why I've been able to recommend quality deals is mentors I've had in the space that have taught me what to look for, and I'll get into some of that in a second. And the ability to vet share structure. So let's break down, I guess, what I've been taught is the number one most important thing is people. Because at the end of the day, it's the people who are driving the project forward. And as you said, there's a lot of pitfalls in the junior mining space. I mean, Vancouver has not a very good track record of making people's capital be worth more than when they invested. They have, in fact, track record of destroying capital in the junior mining sector. And that's because a lot of these companies are what I like to call lifestyle companies. You know, they're in the business of raising capital to fund their lifestyles and salaries as opposed to really deliver shareholder wealth. And so you have to vet out the people that have been successful in past projects. That's the number one most important thing for me is look for people that have increased other shareholders' wealth before, because those are the people that end up doing it again. And then the second thing I always harp on is share structure. And that's the most important thing when dealing with these small companies, because it's a complex topic, but many times these companies will raise money at extremely low prices, a penny a share or 5 cents a share, and then go out to the public or to the retail accredited investor crowd and raise money at much higher prices, 30 or 50 or 60 cents. And so to me, those deals never work because human nature is very tough to fight. And if you have large groups of insiders in at a penny or 5 cents, when a stock gets to 30 or 40 or 50 cents, it's very tough for them not to sell because their gain is so large. What happens is one or more of those shareholders ends up selling into the deal and caps the upside because they're selling into the new capital that's coming in. And so it doesn't allow the stock to appreciate. It just creates churn. And I hate to say it, but more often than not, I find bad share structures when I get emailed a new company to look at or a new slide deck to look at than good share structures. So, I want to see a nice tight share structure, as few shares out as possible. And I want to know that there's not a lot of people in at cheaper prices than I am. And if they are in at cheaper prices than I am, I want to see one of two things. One, that they've locked their shares up voluntarily, that they've registered those shares in their own name and they've put them in escrow or otherwise, said in some legal document that they're not going to sell for X amount of time. And the second thing is, if they are in at cheaper prices, I want to see that they're participating in the same round that I'm participating in to maintain their ownership stake. So that way they're on equal footing as you. They have their interests are aligned with you because they're participating now at the same price. I hope that makes sense and it's not too into the world of private placements. But those are the two biggest things I look for to help iron out risk for sure.
No, I think those are some things that I think in general you can relate to private placements in general. But let's talk about that because you deal. We talk a lot about private placements on this show with regards to things real estate, or, life settlement funds, et cetera, things like that. But how about in terms of the types of private placements that you do in this kind of, or that you help consumers with, advise them on. What are some of the advantages in getting involved in private placements as opposed to just buying stocks?
Yep. The number one advantage in most of these private placements is that you get right off the bat, you get a discount to market. So I'll make up a hypothetical example. A stock is trading at 25 cents and the company is going to raise a couple of $1 million. Well, they can price lock with the exchange and they can do that at some percentage within the price that the stock is currently trading. So you might get to do a private placement in that 25-cent stock at 20 cents. So boom, right off the bat there, you're getting a 20% discount to market. Right. The other advantage is they typically come with some form of warrant. Not all deals, but many deals, private placements, come with either either a half warrant or a full warrant. And that gives you leverage to the future because that stock can go to zero and you don't have any more risk. But if that 25-cent stock goes to 50 cents or a dollar, you have the ability with that warrant to buy more shares in the future at a discounted price. So those are the two main advantages that I convey to readers is the discount to market and the ability to buy more in the future at a lower price.
Right, right. So kind of what I was getting at with this is that, some listeners out there are probably thinking, Buck, we're talking about a very volatile area, buying stocks, et cetera. But, one of my rules of thumb is I'm just opportunistic, right? So if you show me an opportunity where the cards are stacked in my favor, I'm interested in. And kind of what I was getting at was in this area with private placements, I really, really do like it if you find the right, community or the advice, because exactly what you said, because the private placements a lot of times will have basically a fixed discount and you do have to hold for a period of time. But what that allows you to do is potentially get in, sell at some point, take your risk off the table, and then you've got your warrants. And so effectively you've got this opportunity to create, money out of nothing at that point.
That's exactly right. They call it clipping the warrant or whatever, like it's a coupon. So
Right.
You recoup your original investment capital by selling the shares that you got in that private placement. And then you can potentially use that capital at some point down the road, like you say, to exercise those warrants to create almost money out of nothing. And I will say, you mentioned that there's a hold period. And yes, that typically is the case. You have to hold these shares for 4 months. And that's because they're filed without a prospectus. That's what makes them a private placement. They're done privately without the public filing of a prospectus. But in some cases, not very often, but I've been involved in a couple of deals, private deals, that are filed with a prospectus. And in that case, you don't have to wait the 4 months. So you're free to sell the shares either when the deal closes or if it's a private company that's going public either via IPO or some other transaction like a reverse takeover, you can sell those shares the day the deal closes or IPOs. And that's only if they file a prospectus. But that would just be another advantage, to your previous question. If you don't have to hold the shares for 4 months, then that's even a better advantage.
Right, absolutely. And obviously, on top of that, the fixed discount is huge, right? I mean, if you're getting a 20%, haircut, you're taking 20% right away. It certainly mitigates a lot of the risk. But it's certainly something for people who are interested to think about, to get involved with in this area, which I think a lot of the experts think we're really heading into a bull market. How can you get involved without just being another person buying stocks and so on and so forth? One thing I do want to point out is that there are so many of these services out there, and you can comment on this, but you got to be really careful because they're designed, they're sort of what we would call the pump and dump factories, right? Where they'll tell you to buy a bunch of stuff, and just as, if they have enough listeners listening to them, everybody will buy, the price will go up if it's a small cap stock, and then all of a sudden the people who are advising it are the ones who are selling the stock and taking the gains.
They're creating a liquidity event for themselves, right?
Right.
And that's definitely something that you have to look out for. I would always read the fine print of that, scroll all the way to the bottom of the page of the blog or the newsletter or whatever it is, and see. I mean, they have to disclose if that's the case, either if they're being paid to put out the recommendation or that rosy report, they have to disclose that. And if they own shares, they have to disclose that as well. And I think that's what sort of sets me apart from some of those services is that, one, I never get paid to recommend a stock or to generate a positive report about a stock. I only make money from the sale of subscription receipts to my newsletter readers. And the other is I'm often participating, and I tell you this, alongside you. So I'm eating my own cooking, as they like to call it. I'm participating in that same deal that I'm advising you participate in. So it's not like I'm an armchair quarterback in that respect. I'm actually playing the game.
What kind of track record have you had in the last couple of years?
It's been quite positive. So just the private placements exclusively, not the stock recommendations. We've done something like 40 of those placements. 80% of those have been winners. And I'm not looking at my portfolio, but off the top of my head, at least a dozen of those have been triple digit winners or better, including one that was a 1,400% gain. So, I think the track record is quite good. I bet the deals myself. I bet the deals with my network. And like I say, I only make money if my subscribers make money, because then they renew, and I don't take money from the companies, so I got to perform.
Yeah, and this is definitely one of those areas that you really want to surround yourself with, people who know what they're doing and advice and that kind of thing. I would highly recommend, if this is of interest to you, to check out Nick's blog. Now, you've also, you've written a little bit, and I found it was interesting that it sounds like you're somewhat involved with the marijuana industry. Is that right?
Yeah, we've done a couple of private placements in the cannabis space. And we also, inside of the Outsider Club, we have a number of paid newsletters that cover different sectors. And one of my editors writes a dedicated cannabis letter called the Marijuana Manifesto. I think it's very early days in that sector for sure.
Yeah, do you do private placements on that too?
Yeah, we've done, I don't know if I'm allowed to mention individual companies, but yeah, we've done some private placements with some very real companies. Companies that are some of the biggest growers in Canada. We haven't gotten too much into the US yet, just because it's not legal at the federal level. But I suspect that it's going to be, my analogy is the gay marriage analogy. It was legalized by one state, Massachusetts, first, and then a couple of other states followed on. And then about 10 years later, there was a Supreme Court case that deemed same-sex marriage legal federally. I think that the marijuana space is going to follow a similar trajectory. You've got a handful of states that have legalized it in a recreational capacity now. California is now just about to go legal recreationally. And all these other states are really getting jealous of the tax revenue that they're generating.
Sure.
And so you'll start to see these other states follow suit, and then there'll be some Supreme Court case or some congressional or presidential decision that allows it to become legal federally. And so I think that's literally the end of prohibition, not of alcohol, but of cannabis. And so if you look back at the fortunes that were made at the end of alcohol prohibition, it's just going to be rinse and repeat, I think, for cannabis.
Yeah, it's interesting you say that. I've used the exact same analogy, and I've said the same thing. I think the tricky thing that I found with cannabis, because, frankly, again, I am agnostic when it comes to an asset class, and some people have issues with cannabis. Frankly, I don't really care, and I agree with you. I think it's the end of prohibition, and we're gonna, eventually there will be people who come out who 20, 30 years from now, there'll be the Budweiser, the Miller, the Coors of the pot industry, and people are sitting on the sidelines and wishing it would go away. It's just not going to happen. So you might as well potentially look at ways to make money. You know what? You're
seeing that happen right now. I don't mean to interrupt, but
sure.
you're seeing that happen right now. It was just last week or the week prior that Constellation Brands, which is the company that is responsible for the distribution of Corona beer in the United States, they took a major equity position in a company called Canopy Growth, which is one of the biggest cannabis growers in Canada. And so that's the first shot over the bow, right? Just like you say, the major beer brands are saying, hey, wait a minute, we don't want people smoking dope and not drinking beer, so let's get in on this. You know?
They'll probably drink more beer if they smoke this.
Who knows? I don't know how that works, but I know they're fearful.
Yeah. So is that part of the same newsletter?
The private placements are, in the cannabis space, I do them through a service called Nick's Notebook. But if you want to buy retail shares of cannabis stocks, we have a letter just for that called the Marijuana Manifesto. Yep.
Yeah, interesting. So it's funny because, Nick, I was about to say is that I've looked into some of these. I've had some people email me because they know I'm always looking for stuff. And one time I had an opportunity presented to me. I thought it sounded really interesting, actually. So the guy actually comes, he says he wants to come and visit me. So he comes, this is when I lived in Chicago, and we met him at a Starbucks. And it was like, I couldn't even believe this. The guy comes in, and it was like, I think he was stoned for one thing. And he had his hat was on sideways, and he was totally. I mean, it was just unbelievable, and it could have been a great opportunity. But I mean, who knows? I mean, this is a an industry with some shady characters, and so you don't know. I mean, if you're looking for a great opportunity, there's there may be one there, but you have to look through. You have to look through a lot of stuff. Now, let me ask you this: if you had $100,000 to invest right now, given where, I'm not talking about any particular investment, but generally, broadly speaking, what would you do with it, given where you think the economy is going to be in a couple of years?
Are you talking about sort of a mainstream investment? Or are you talking about
anything.
Like speculative capital?
Well, if you had $100,000 and say you want to allocate it to some things that might be mainstream, might be speculative, what would you do?
Yeah, I'm 100% convinced that the uranium market is going to have a very long and sustained bull market period quite soon. Just last week, the one of the largest uranium producers in the world, Cameco, announced that they're cutting production by 10%. And we saw nearly a 20 to 30% gap up in all uranium equities across the board. That was no real movement in commodity price, no real movement in actually supply or demand, just an announcement that a company is going to cut supply next year. So that just shows you how ripe that market is. I said earlier in this podcast that uranium equities were debased 90% across the board since Fukushima. I mean, for me as a contrarian, that's as a sure bet as it gets. I mean, uranium supplies 10% of the world's baseload electricity. It does so in a clean way with no emissions. So if we're really looking toward the electrification of the grid, the electrification of cars and internal combustion motors, you can't, as much as I love solar and wind, you can't sustain that transition with just solar and wind unless you have a major revolution in batteries, because you have to be able to store that energy cheaply enough to make it economic to charge all the batteries. And right now, nuclear is the only way to do that. So if you're giving me $100,000 and I'm picking one sector, I think I'm going to invest in the best of breed uranium producers and juniors that own high quality assets run by quality people.
Fantastic. So Nick, you want to let us know, where can we learn more? Tell us about all the different things you got, because there's there's some notebooks, there's blogs.
Yeah. If you just go to outsiderclub.com, www.outsiderclub.com, everything is right there. You can sign up for free daily editorials. We'll send those to you 7 days a week. Or if you click the publications button, you'll see a list of all the paid publications we have that cover different sectors of the stock market and give specific recommendations by our editors. I think the one that probably is most useful for your audience is, like you say, the Nick's Notebook service. And that's where I exclusively vet and share with my small group of accredited investors private placements that I consider worthy of putting your capital in.
Sounds great. Nick Hodge, thank you very much for being on the show.
Buck, that was a lot of fun. I certainly appreciate it.
We'll be right back. What do the Rothschilds, the Romneys, and the billionaire hedge fund managers know that you don't about growing and protecting wealth? As you might imagine, the wealthy have a few tricks up their sleeves. One strategy allows you to grow wealth tax-free at a compounding rate with no volatility. It protects your money from creditors and lawsuits, and it lets you invest the same money in two different places at the same time. How about that for amplifying wealth? To learn more, go to wealthformulabanking.com. Again, that's wealthformulabanking.com. Attention accredited investors, I've got an opportunity for you. This property has been featured by Time Magazine and Coastal Living. It's called Mahogany Bay Village, and it's a first major luxury branded hotel in Ambergris Caye, Belize, TripAdvisor's #1 island destination. Enjoy fractional ownership in a resort branded by one of the most recognized hotel brands in the world. Buy new vacation rental inventory below market value. Still not convinced? Well, how about double-digit projected returns? Go to wealthformula.com under our investment opportunities tab and click Mahogany Bay Village. This opportunity is not going to be around for long, so don't miss the boat. Welcome back. I hope you enjoyed that show. So this whole concept of outsider versus insider is true, my friends. Now, If you can't become an insider, though, you're probably thinking to yourself, all right, okay, I get it. What's this show? What's the point? I'm not going to become an insider anytime soon. How do you get an unfair advantage anyway? Well, we talked about, for one thing, stick to your basics, right? All the principles of wealth building that we talk about, real assets, cash flow, investing in things with leverage and velocity. That's one thing. Stick to that. But also, as you know, I have advocated many times to invest within your tribe. Create a tribe. When you do this, when you're part of a tribe, when you're part of a group of people with common goals, common belief systems, different skill sets and knowledge and different experiences. When you do this, you can leverage the knowledge of everyone around you, create checks and balances for investment opportunities and sponsors. You know what people are doing well in. So why reinvent the wheel? I mean, just take the ride for yourself. In a way, that building of the tribe is essentially the same kind of thing that I'm talking about here with insiders and outsiders. They're just, the ultra wealthy, they're just more refined tribes. They're just dealing with higher sums of money, and they attract, bigger. They deal with people who are positioned, in places that can make things even more dramatic. So that's certainly something you can do, and certainly, check out Nick's Outsider Club thing too. You might really like it, and he has, his own approach to this, which I think might be a benefit to people, particularly if this whole idea, the energy or the precious metal sector and commodities appeals to you, which, it certainly does appeal to me. And that's another show entirely, but I will talk about that some other time. Now, I do want to point out, again, for those of you thinking, how am I going to get this tribe? Where do I even start? I'm kind of on an island here. In Q1 of this year, I'm going to be releasing a course, and I don't know if I've talked about this yet, but it's going to be called Your Roadmap to Real Wealth. And it's super exciting, actually. There's going to be some just fantastic faculty on this, etc. And then that is going to lead into the Wealth Formula Network, which will be the online forum where all of you can connect. And that's where you can start working on your tribe. Now, also remember, for those of you who are accredited investors, and an accredited investor, of course, is somebody who makes $200,000 per year, $300,000 if filing jointly, or has a net worth of $1 million outside of your personal residence. They made that one because of California, by the way. Then you are an accredited investor. You don't have to sign up for anything or fill out an application or whatever. You just are. It's like being pregnant or not pregnant. You just are. And if you meet those criteria as an accredited investor, you can join my investor club, which is my tribe. Just go to wealthformula.com and click on the investor club icon. Now, finally, if you like the show, if you like it, if you're a listener, can you please do me a favor? Go to iTunes, express yourself, give me a 5-star review, and make sure that you subscribe to the show if you're not already subscribed. The reason I ask you to do that is because that helps the show climb in the rankings. And when the show climbs in the rankings, it helps me continue to have the leverage. Notice I like leverage, right? To bring high quality guests to this program and continue to bring high quality guests to this program. There's at this point, we've had some pretty spectacular people. So it's not like we're trying to climb higher. We're just trying to get more. We just want to be able to get anybody we want. And the key is just to continue to plug away. We've got a great listenership. I appreciate you all very, very much. And anyway, that's it for me this week. This is Buck Joffrey for Wealth Formula Podcast, signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.